now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. Of course, it's the Hump Day edition of The Real Investment Show. That means Danny Ratliff will be joining me this morning to talk about, is a soft landing coming, right? It's the no recession scenario. You know, that's the big question. That's the big debate right now going into 2024, whether or not we're going to have a recession. A lot of indicators, of course, suggest we will, like leading economic indicators, consumer confidence, certainly quite a few others. Yield curve inversions certainly suggest that a recession is likely next year, but there's other indicators starting to show signs of improvement, like the ISM services index yesterday, remaining in expansionary territory. So, are we going to have a recession or not? It's easy to jump into the camp that, yeah, we're definitely going to have one because of the Fed rate hikes, etc. But again, we have to go back to the fact that we just have a lot of money sloshing around the economy. Just there's a word for it I can't use on the round. It requires, we've said before, economic growth. You've got to have economic activity to generate the revenue, right? You and I have to go out, we've got to buy stuff, we've got to spend money, we've got to do things in the economy. That's what generates the revenue. We got to go out and buy a new iPhone, right? So Apple makes their revenue. And so if you don't have strong economic growth next year, right, if you're expecting a recession, you can't have those earnings. And if you can't have those earnings, as we talked about yesterday, here on the show, as we went through the article yesterday, these expectations for new record highs in the markets by next year becomes a bit more challenging. So again, just a lot rides on whether or not the economy can avoid a recession or not. That's going to be the big question. The other side of this, and one thing we have to consider, is that maybe we don't have a recession next year. What if it's the year after, right? So timing is also a very important factor in all of this equation. And so this is why we've talked so much this year, particularly over the last several months, about biases and probabilities versus possibilities, not getting wrapped up into narratives. Because again, as we've talked about before, there's all these narratives floating around, the death of the dollar, and then the dollar rallies strongly, right? And then there's this other narrative about, whatever it is. And so we all get wrapped up in these narratives, and that has to explain why something's happening. And again, things change. Just a couple of months ago in October, everybody was extremely bearish. Now everybody's extremely bullish. In a month, we had a massive change from from bearishness to bullishness in investor sentiment. Right? In just a month, everybody went from basically being in the bunker to being on top of the mountain, right? And so again, that's contrarian signal, suggests that markets are going to have a bit of a correction here. But those are the scenarios that we have to deal with, and this is why it's made navigating the market so incredibly difficult this year. And I get a lot of emails from people just making big investment mistakes. Good example was I had an email yesterday about 401k plans. It's like, I don't like my 401k plan. There's just some, just a handful of choices in my 401k plan. What can I do with it? Don't worry about that, right? Your 401k plan, especially if you're in your 30s, right? If you're in your 30s or even your early 40s, your 401k plan, just invest into the market, right? That's your retirement money. That's going to be that you're going to be investing for another 20, 25 years. Worry less about the market and worry more about your savings rate. Make sure you're maximizing that 401k plan every year. Now, if you're in your 50s and you're starting to, like me, starting to head towards that retirement, kind of situation at some point, risk management now becomes much more important. You've built your nest egg. You've got your nest egg built, right? You've done a good job of saving, hopefully up to this point. And now you've got to protect what you have. And so this is something Danny and I are going to talk a bit more about this morning, but this is something that you have to kind of deal with, is the different phases of life relative to where the markets are. And again, if you're young, if you're in your 20s, worry a lot less about these narratives that are out there, because 99% of those narratives aren't ever going to come true. That's just the way things work. And you have lots of time on your side. If you're closer to retirement, still forget the narratives, because most of the narratives are wrong, but focus more on risk management, because you've got limited time to make up for a downturn in the markets. And so time is important. You hear a lot of conversations about time in the market. It's true. The problem is that you may not have the time you need, right? And that's why investment strategies have to be different over time. And like I said, Danny and I are going to talk more about that this morning as we talk about, the outlook for a recession. What's the indicators telling us? We'll talk about that when we come back. But here's what you need to know before the bell this morning. Yesterday, of course, market slopped around a bit yesterday again. And, this has been really kind of the status over the last couple of weeks. Remember a couple of weeks ago, we said that this market rally was getting very extended and that we were going to have a correction probably in the first couple of weeks of December. Well, here we are. And a correction can also be a consolidation, as we talked about. Markets can just kind of go sideways for a while, work off some of that overbought condition. That's really what's been going on here. Now, we haven't worked off much of the overbought condition because the market has yes, been trading sideways, but it's been a very, very tight range. So we've been unable to work off that overbought condition. So we've got more work to do here. But yesterday, again, the markets just kind of continue within this range, really have not been able to break out of this range at all here over the last, really kind of the last 10 trading days. And that's okay. That's kind of part and parcel for how markets act. And particularly at this time of the year, we had near record amount of a 4-week average of stock buybacks that started right here at the beginning of November. That's really been the big contributor to this rally, has been these stock buybacks that's been going on. Now, the stock buyback window closes Friday. So after Friday, this big lift to the market is going to lose one of its major drivers, which has been those stock buybacks. Now, having said that, though, nonetheless here, the markets are still very elevated. We're still very close to a sell signal. Didn't quite trigger it yesterday. There was just enough buying yesterday to keep the sell signal from triggering, but we are very, very close to it. So really any type of downturn today. So markets are looking to open up a little bit this morning. Not surprising because we've had these last couple of days of chop. But whether or not the markets can hold on to those gains today is going to be important. If we open up and then sell off during the day, that's going to continue to weigh on the signal. But we're very close to triggering the sell signal. Again, it's just hanging in there by a thread right now. Considering how elevated that signal too is that yes, the markets could try to make one more last kind of hoorah here. We'll see again. But once we get past this week, then the next week or so, volume is going to dry up markedly and buybacks go away. So again, there's the risk here of still a bit of a correction. Markets are still extended well above their 50-day moving average. We're close to a sell signal. Volume is declining here. And again, you're about to lose a driver. So again, just from a risk management standpoint, continue to be a little bit cautious about exposure here. As we talked about yesterday, great time to do some tax loss harvesting, take out positions in your portfolio, reduce overweight positions, take profits, those type of things. Great time to do that. Even if the market doesn't correct and we just consolidate here for another couple of weeks before the end of the year, before that year-end rally, that will still work off some of that condition if we just continue to grind sideways, which is a possibility. And that'll let these moving averages catch up, etc. So again, just be cautious here. Don't be a little bit, don't get too overly excited. Markets are still kind of in this work-off process after this very big run. That's what you need to know before the bell this morning. When we come back from the break, we'll pick up with Danny Ratliff. We'll talk about investing, markets, recession, all that's more coming up right here on The Real Investment Show. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, or again, simply online at realinvestmentadvice.com.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome to the show this morning. Danny Ratliff joining me, of course, here to talk a little bit about a couple of things this morning. And one, we'll start with this kind of this idea of soft landing, recession, no recession. This is the big debate. And the reason this is such an important debate, and let me just tell you right up front, neither Danny or I know the answer, right? So we don't know. Nobody knows whether or not the economy will be in a recession this year. There's certainly lots of indicators that suggest it will. There's also other indicators that suggest it won't. And this is why navigating markets, has been difficult over the last year and will continue to be difficult next year as well. But it's the importance of, the outcome will have a lot to do with how markets perform, but it's also important not to get narratives out of whack with what markets will actually do. And again, this is the big problem for investors is they get kind of wrapped up into a narrative and they go, I've got to just put all my money into this, and because this is going to happen for sure, there's no way around it. And then it doesn't happen. And then, you've missed, the move in the market or whatever it is. So, this is the big challenge. And this is the part about risk management and keeping a focus on things that are happening, but not letting that override your investment goals and objectives, because, there is a process to making money, and time is a big factor. And this is why, I talked a little bit earlier about time. And, different stages of life, time is very important. And it changes the way you should invest when you have a lot of time or have very little time. And so we'll talk about that this morning as well. Anyway, good morning, Danny. How are you?
Hey, good morning. Doing great. How about you?
Good. Getting ready to wrap up the year.
Seems like it just started.
I talked a little bit about this yesterday, but I thought maybe you might want to throw your hat in the ring for a minute, just talking about, give your advisor a break and stuff that you need to be doing right now and not wait till the last, 3 days of the year to do.
Well,
make RMD. Yesterday, as I mentioned, go ahead and get your RMDs done.
Yep.
If you haven't done them yet.
Yeah, I think that's an easy one, right? I mean, we know that we're going to have to do that throughout the year, by December 31st. Many people want to wait until the very end. And the problem is some of these custodians have gotten so large and so busy at this time of year, it can take them a little bit longer to process things. So I highly encourage people to go ahead and get that done earlier, sooner rather than later, especially now we're into December. Another one I think that many people put off is charitable giving. Mm-hmm. And this is really important, especially if you're looking for tax breaks. And there's a lot of different ways to do so. It may be donating a highly appreciated stock versus just donating cash. Maybe looking to a donor-advised fund or a private charitable foundation. I think donor-advised fund is probably going to be a lot easier, and it's something you could also bundle. So if you had, a large payout, you had deferred comp, you sold a business, this may be a way that you go ahead and put additional funds into something and, you're not going to donate it all. You're going to put it aside all at once, but you may not gift it all at once. And so, you get the tax break for this year, but you're going to use it in subsequent years. And I think that's one tool that people don't use often enough. And it's tough sometimes because you may say, well, I'm going to give XYZ Foundation or the church X amount of money every year. So I'm going to make up a number, $10,000. But maybe you want to put aside $50,000 to offset some taxes. And for many people, it's really tough to part with the money, just like writing a check to the IRS.
Exactly. Well, it just depends. Do you want to donate your money to the IRS, or you want to donate your money to a good cause? Toys for Tots is a good example. This time of the year, it's a big drive by Toys for Tots every year. This time of year, so you have your choice. You can give some money to Toys for Tots. You can give it to the IRS. They're both charitable organizations. They depend on your charity. So, one is just forced charity. That's the only difference.
Yeah, isn't that the truth? So, those are some of the easy things. Now, I think you should also go through and check your employer benefits. Have you maxed those benefits out? Do you need to make any last minute tweaks?
Yeah.
What about your HSA plan, health savings accounts? We talk about this frequently, that many people get HSAs and FSAs confused. And there's a big differentiator, right? FSAs are flexible spending accounts. You have to use that by the end of the year. Some plans allow you to use it all the way up until March. But if you don't use it, you lose it. HSAs, health savings accounts, will allow you to actually put those funds aside and let those grow. Now, you have to use them for medical expenses, but we know the numbers. We talk about the numbers. If you've listened to the show for any length of time, this is one of my favorite accounts. You can't contribute a ton of money to it, but you don't have to use it. And so the benefit of an account like this is that it grows tax-free, but not only that, it gives you a triple tax benefit. You actually get a deduction, so it reduces your income. It allows you to grow those funds to tax-free. And then when you distribute them for medical expenses, you're not paying taxes on it. So only account in the world, triple tax benefit. Utilize it if you have the ability to. Now, you have to be on a high deductible health insurance plan. If you're not on a high deductible health plan, you don't have access to it. So some of you out there, you can't even contribute to it. But if you can, make sure you're using it properly, and ideally pay your medical expenses out of pocket if you can, and let those funds grow. So, I think these are just the low-hanging fruit.
Yeah.
If go through, check your employer benefits, make sure you're not leaving anything out there, make sure you're collecting everything you can from your employer, and then just tying these things up before the year end. And, ideally, you probably want to do it right now because you may only have one or two more pay periods that you can actually utilize this.
Right. And, we talked about yesterday tax loss harvesting. This, markets had a great rally. We're kind of stalling up here. If you haven't done your tax loss harvesting this year, selling your losers, go do it. Right. I mean, this is probably as good of an opportunity as you're going to get, and use those to offset gains in the future. So.
Well, and keep in mind, so I think this is a tough one for a lot of people. We've had years where we've had very little that we can sell to tax loss harvest. And you're like, oh, shoot, what do you do here, right? There's not a whole lot of opportunity in a really good year. But in years where we've had, like this year, for instance, where, a small portion of the market has done really well, with the exception of that, a lot of other areas have not performed very well until this last month. This gives you that opportunity. And so, most people get hung up, I think, Lance, on saying, well, I can only deduct $3,000 a year over what you have in capital gains.
Right. And this is a huge point because I get this email all the time.
Yep.
And there's such a misunderstanding around it. So if you have losses, you can offset $3,000 of your losses.
No. You can offset it. You could have $100,000
well, hold on.
gain.
Let me. This is the email I get, right?
Okay.
So, I can, I have these losses. I can only take off $3,000 a year. It's going to take me 20 years to offset this loss. That's not the way it works. It's now explain how it works.
you could have. I mean, we're just going to use big numbers here, but you could have $100,000 gain that you've taken in something, and you could have $100,000 loss on the other side of the ledger that you could, or let's say it's $120,000. You could go ahead and take that, offset that $100,000 gain with that $100,000 loss. Now you have an additional $20,000. You say, well, what do I do with it? Well, you're going to be able to deduct an additional $3,000 on top of that $100,000 that you've offset. So it'll help you in that aspect. And then that $17,000 you would be able to carry forward for other years. So those losses you can carry forward indefinitely. So I've heard people say, like, well, I took this loss. I'm not really sure why I did it, or how do I use this in the future? It'll take me my whole lifetime to do $3,000. Like, well, no, hang on.
Right.
You have a gain next year. let's say it is $17,000. That $17,000 that you sold this year will help to offset that gain in future years.
Now, you do have to make sure that if you're doing your own tax filing, right, then this is now like my accountant does it for me. But if you're doing your own tax filing, you got to make sure and roll that loss forward every year, and on your, be sure and carry it forward from the previous years into the current year so it doesn't fall off, along the way. But yeah, this is the big misnomer about losses is that, it's just I can only take $3,000 a year. I won't live long enough to, take that loss, whatever it is. No, all you need is a year where you have a market up 25%, and then you take gains, offset that, bring your capital gains to zero for the year, and then carry over whatever balance is for the next year. Or if you sell a business or wherever you generate a capital gain, you can use those losses against that gain in the future. So it's a good benefit to do some tax loss harvesting. It also will help you in the future when you need it on your taxes.
No, that's exactly right. And I think that, understanding how that works is extremely beneficial. And then knowing when to do it. Now, the other caveat to that is you can sell something, but there's also the wash rule. And, on smaller things, you may not say, hey, that's not a big deal. But if you're doing it solely for the purpose of saving, taking that loss, we have to be careful. And so, big picture, you may not want to get out of, XYZ fund and go buy the exact same fund. You want to buy something different. You have the wash rule. You have to stay out for 30 days. So make sure you know that number, put it on your calendar, put it on your phone. I mean, they make it easy these days to kind of track. But I think that's one point where you see people make that mistake as well.
And, look, ETFs have made that so easy now because, like, for instance, if you sell XLK, the iShares Technology ETF, right, you can sell that, and then you can turn around and buy an ETF of technology of another ETF manufacturer the next day, and that won't violate your wash-sell rule. So it's gotten a lot easier with ETFs. What you can't do, and this is where you've got, and what Danny's talking about, I can't sell Apple today at a loss and then buy it back tomorrow. I can't buy Apple back tomorrow. I've got to wait 31 days before I buy it back to keep that loss valid. So again, there's, it's not as clear cut as it used to be when it was just stocks. Mutual funds have really
but you still have to be careful with mutual funds and
absolutely.
ETFs, because there could be some gray area or some areas where they're subjective, where they say, well, this is actually the same thing.
Yeah.
So I always kind of advocate, hey, let's look at a different area for a bit or something a little bit different. Then you can circle back to that at a later date, if you still like it. Yeah,
exactly. Okay, look, we didn't get to recession yet, but when we come back from the break, we'll pick up with, is it a recession next year? Is that a guarantee as we head into next year or not? We'll talk about that with Danny when we come back from the break. Don't go away.
Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
You can get daily real investment news you can use, delivered at the speed of the internet. Sign up for Lance's newsletter now at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Friday was actually December the 1st. The reason I know that, wife's birthday, can't miss that. So, 39 again, holding steady, looks great, it's all good.
The Real Investment Show podcast. Same show, your schedule.
With my wife, the birthday goes the entire weekend. It's not just Friday, it's Saturday and Sunday. It was a lot of servitude over the weekend.
At realinvestmentadvice.com.
Kind of glad it's Monday and she had to go back to work.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Real Investment Show podcasts are now available on iTunes. Listen anyplace, anytime at itunes.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell report. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So, recession or not, job data. We had JOLTS data out yesterday. Employment report is Friday. So, again, this is what everybody's kind of looking at right now because the employment data has been, it's been good, right? It's unemployment rate remains low. JOLTS openings turnover survey was weaker than expected yesterday, but still elevated. So the question, of course, and this has been the big driver for the Federal Reserve is, they're keeping rates elevated to combat inflation. And of course, the concern is that higher interest rates are going to lead to a recession ultimately, but it hasn't really shown up yet in the employment data. And this has been the one thing that the mainstream media is kind of holding on to as terms of this soft landing scenario. And again, when we talk about soft landings, by the way, we have to go back to 1995. In 1995, the Fed was hiking rates and we did not have a recession. Now, we just come out of a recession in 1991. So the Fed was hiking rates in 1995 and we didn't have a recession. And in 1998, basically we had the long-term capital management. We had Asian contagion along the way. We had a lot of stuff that was breaking because of higher interest rates, but we had no recession. And then in 1998, the Federal Reserve started to cut rates a little bit and then began to hike rates going into 2000 as Alan Greenspan began to worry about this inflation boogie monster, and that led to the dot-com crisis. So 1995 is the target we all look back at and we say, oh, see, that's a soft landing. Well, the difference between today and 1995 is that yield curves were never inverted in 1995. We never had an inverted yield curve in 1995. Yield curves did not invert until 1998, and they uninverted in 2000, which is your signal for a recession. Today, we have inverted yield curves, and which is a big difference to where we were in 1995. And that, these inverted yield curves historically always precede a recessionary onset when those yield curves un-invert. They haven't un-inverted yet, but they will eventually. So the question is, recession, no recession, and this is the big driver for next year is that if the Fed can bring down inflation, keep employment strong, keep the economy going, then that should be a great scenario for stocks, right? Stocks should do well. Bond yields will come down, bond prices will go up, stock prices will go up because of lower inflation and a still kind of a kind of still strong economy, right? The economy is still growing. It's not maybe it's not growing at 6%, but it's growing at 1 or 2%, and it's doing enough to generate earnings for companies. And this is the kind of the bias for the outlook next year for the markets, that it'll be another up year for markets. But this is the big debate right now, Danny. This is the challenge as we head to next year. Recession, no recession. What do you think?
Yeah, I mean, I think this is difficult because, you do look at the indicators, inverted yield curve, leading economic index down for, 19 consecutive months, all really big kind of flashing yellow lights. And then you get all these prognosticators saying, hey, here's the forecast. And, I always take that with a grain of salt in the sense that, we hear somebody who is so dead set. And many times you have to be careful where the information is coming from. Like, what are they trying to sell you? Does this guy only sell gold? And is that what his portfolio is comprised of? Because he would have sold you gold 10 years ago. He'd have sold you gold at any time. Yep. But typically the gold narrative is that, hey, the sky is falling. This is the only place that you can be. And I'm not picking on gold. I'm just using that as an example. But, there's many of these people out that get it wrong on a regular basis. And this is difficult. And this is why I think that we're kind of, if we're talking to people, like, we are very nimble with how we manage money, what we do, because we do realize narratives can change. Now, there are going to be some things that you may hold higher convictions in, but overall, you need to be willing to say, hey, we may be wrong. I think we're probably always cautiously optimistic. It's probably the best way I would describe that. But we also know the risk out there probably more than most and are willing to make changes along the way. But for many, it's just, hey, it's always a bull market, or everything's always great, or it's always bad. I was listening to somebody on a podcast not long ago, and he's like, well, I tell you what, when this changes, we get this recession, I'm going to turn super bullish. You're going to know it. And I'm thinking, like, you can follow this guy. I can't remember his name right now. But he's never been bullish, ever.
Yeah.
So it's like, I don't think that's necessarily true. But, fear sells. And so this is where I think many people get into problems, right? I mean, we look at the yield curve. We look at those. Just use those two as an example, leading economic index and the yield curve. They've both gone on for longer periods of time than what they've on average done before they've triggered a recession.
Right.
Now, we may find out that we're actually in one further down the road. They revise numbers, data comes back, things change. But right now, and the other difficult part about this market has been that, we look at an index and most people we talk to are like, that's not what the return I've got, right? Unless you're purely in that index or in those big tech companies, the majority of the market has not performed very well, and bonds are still down for the year. So that's where I think it's difficult. So people see that. I think that people are tired.
Yep.
This has been a long 2 years in the sense of how the markets have worked, what's going on. And, I think we want to, put that and tie that with the economy so closely, but those two don't always go hand in hand. As much as weird as that sounds, this can remain, irrational longer than we can remain rational. I probably say that on a weekly basis because it can. And if you look at, most of these people say that, the sky is falling, it will inevitably, and that's what we'll remember, but we'll forget how long it took them to get to that point. And so we have to be careful with those narratives. And I think you mentioned it last segment that, you get so many people that'll just go all in on one theme, and that is it. All in, 100%. Yeah. I'm either all the way out of the market, I'm all the way in the market. Usually we do it all at the wrong times, right? We get all the way out when things are really bad. We get all the way in when things are already really good. I mean, we had people, leading up to 2020, and shoot, even a little bit longer than that, we had people calling us like, hey, I've been out of the market since 2008 or 2009. I need to get back in. We're like, whoa, this is a tough time. Let's step in slowly. But, we talk to people who just, it's difficult because we get so emotionally tied. And I understand it. This is your money. It's your livelihood. It's your security. But we also have to understand how these markets work and be willing to make changes along the way. And so do we go into recession? I would think that things point that direction here at some point. Now, the question is it 3 months from now? Is it a year from now? I don't think anybody knows. I mean,
well, and there's another side to this, which is that we could have a recession, right? And the issue right now is that when people think about recession, they think about the financial crisis.
Correct.
Right. So if we have a recession, markets are going to go down 50%. And look, the normal decline for asset markets, and this was in yesterday's report on the website if you want to go see the table, but the average decline is about 33% historically during a recession. That's good, but that includes those recessions that are down 50%, right? So there's been a few of those, right? 1974, 2008, the dot-com bust, we were down 50%. So you take some of those big 50%ers, but there's a lot of recessions in there where the market's down 12, 13, 15, 18%, those type of things. And so your average turns out to be 33. But this is always the problem with looking at averages over time. Like the average rate of return is not, you don't get 8% every year, even though that's the average. It's just, we have to understand these things. And so if you look at the market where it is right now, it's exactly where it was 2 years ago. You've had zero returns for 2 years in the markets. And we talked about this before, is that, this is, we talk about valuations and how you can have long periods of low returns, near zero, these type of things. And we're not saying that's going to be the case, but you've had 2 years now. You're right where you were 2 years ago. The return of the market's been zero over a 2-year period. And, this is the important thing to look at and to understand that we're in one of those cycles. So the issue here, though, is that we could have a recession. And because we've already been in 2 years of negative returns, the next decline, recessionary decline might only be 10 or 15%, right? It may not be that much. It may be another year like we had in 2022 where the market's down, 18% with dividends. It may not be that world falls out from underneath you. And at the same time that you're having a recession in stocks, you're having a boom or bull market in bonds, right? So this is going to be, this is part of that narrative problem, is that in order to have one of those financial crisis types of event, you're going to need a credit related event of some sort, right? Not just an economic slowdown. And so this is why it's going to be a challenge. And again, we just kind of keep coming back to be careful of these narratives. There's a lot of stuff, out there right now and podcasts and, websites and stuff about, how terrible it's going to be when it comes, and it's going to, it's just going to wipe out Americans and the way of life is going to change, and you better have gold and bullets and beanie weenies, maybe. But that's really one of those events that's on that far right tail of the bell curve that probably isn't going to happen. It'll be somewhere between a normal recession and maybe a bit more difficult recession, but that's going to be probably what we wind up dealing with.
I always find it interesting or kind of funny, and Brent can relate to this, when Lance is no longer the perma bear. Something is going on, right? Like when you on some of these outlets, you're the most bullish or maybe even just pragmatic person out there, because everybody's in their foxhole thinking that the world's coming to an end.
I know, it's look, I'm very cautious about next year, right?
Yeah.
And normally when I'm cautious, I'm the bear, right? So, and now everybody's so bearish that I actually look bullish. So
I know, it's crazy.
It's crazy. Anyway, that's how it works. All right, when we come back from the break, I want to talk a little bit about time. Because this is, and we touched on this in the early segment, but I get a lot of emails from people like, they watch some podcast and they're in their 30s and, they're trying to figure out how to get all their money out of their 401k plan to go buy gold with it. These are huge mistakes. And I want to talk about the importance of time when it comes to investing and how you need to navigate periods in life. And we'll come back and talk with Danny Ratliff about that as well, because that really kind of falls into financial planning also. Don't go away. We'll be right back.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN at realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
So I get a lot of emails every day. Lots of emails every day. And I answer every email every day. So if you ever send an email and I don't respond to you by the end of the day, I didn't get it, right? Something happens in cyberspace and it didn't come in. So if you never get a response to an email, either it was a stupid question, doesn't deserve a response. I'm joking. I even answer those emails. I'll just say that was a stupid question. But I answer every email every day. But I get lots of emails every day, and hey, I get it, right? Lots of concern in the media right now. And again, if you listen to YouTube or TikTok or whatever it is, there's just a ton of stuff out there about how much what's going on in the world, and it's all going to crash, and it's going to take. And so I get these emails from people, and they're like, "Oh, I'm 20 years old. I'm 25. I'm 28. I'm 30. I'm 32." And I want to get all my money out of my 401k plan because I don't like all I have in my 401k plan is an example. This is one example. All I have in my 401k plan is some basic mutual funds. I want to get it out and put it into metals or whatever it is. This is terrible. That's a terrible decision process when you're young. If I could go back when I was 20 years old and I had an access to a 401k plan when I was 20, they didn't exist when I was 20, but that's how old I am.
Hold on, I'm doing the math. I think that's a load of baloney, but...
No, seriously. 401k plans didn't exist when I was 20.
I'm just doing the math on how old you are.
Yeah, I'm 60. I'm almost 6. I'm almost retired, Danny.
Oh, man. You are so funny. So, you're asking this guy for advice. He can't retire. What are y'all doing?
Exactly. So, but the point is, if I was 20 years old and I had something I could contribute to that would grow tax deferred for the next 30 years, just put it into an S&P index fund. There is a truth to the markets, and you hear this from the media quite often. It's the time in the market is very important, and that is a very true statement if you're young, right? And if you're young and just starting out, the biggest way to build wealth is to save money. It doesn't even matter honestly, it doesn't even matter if you invest it. If you can just save money into a bank account, you'll build wealth. Now, if you can invest it smartly and over a long period of time, you're going to build a lot of money. And remember, as investors, our whole goal with investing is not to beat some random benchmark index. It's to adjust our savings for the rate of inflation over time so that our purchasing power parity remains the same in 30 years. $1 million in 1980 is not worth $1 million today, right? So we need to make sure that $1 million in 1980 adjusted for inflation all these years and has the same spending power that it had back in 1980. This is the important concept. So, but it's important about having time. And as you go, and this is where Danny's financial planning comes in when we work with clients, you don't look, if you're 20 years old and you've got 50 grand saved up, awesome. Put it into an S&P index fund, contribute to it every month, turn off the media, and don't look back. You don't need a financial advisor at that age, right? You just don't. Just buy a low-cost index fund, you're fine. Now, once you get to be 45, 40, 45, you've built up a nest egg, you're heading towards 50, you've got a nest egg built up, and your time to retirement is becoming much shorter. Now it becomes important to manage risk because you can't live through a big downturn in the market. You can't lose 50% of your money and then try to get it back before retirement. There's just you don't have the time. See, time is the key component here. As most people know, look, and when you talk to most people that are 20 years old, they don't have any money saved up, right? There's very few people I run into is like, oh, I'm 25, I've been saving for the last 10 years or whatever it is, and I've got 50 grand. Good for you. You're doing awesome because 99% of people your age have no money. And it makes sense, right? In your 20s, you're just getting your first job. In your 30s, you're buying a house and you're raising a family and sending kids to college. In your early 40s, you're not saving any money, most likely. You don't really become a serious saver until probably your mid 40s or even early 50s for most people. And that's where you have to really focus on that saving for retirement. But, the importance of time is very important. And so if you're young, time is on your side, take advantage of it. If you're older, risk management becomes much more important because you don't have the ability to withstand a downturn. That's when you need financial advising. That's when you need all these type of things to help diversify risk and those type of things. But that's the important thing here, Danny.
I'm going to disagree with you a little bit.
Okay, go ahead.
So I look back and think about my 20s, right? I'm in my 40s. Now, granted, I have been blessed. Or dumb enough that I got into this right when I got out of school.
Right.
This is what I've done.
Right.
This is what I know. I've been blessed to have a lot of really good mentors and people around me that have, guided me in the right direction, given me lots of good, sound advice. And so I think when you're young, I know what you're talking about. You're talking about the markets. Like you can put money in the market. You have a very long time. If you're putting a little bit in, you don't have a substantial portion of your wealth tied up because you're just creating it.
Right.
So at that stage, I think, what you're mentioning here from an investment perspective is, hey, fun. Let's put it into the market. You're putting a little bit in. You're going to continue to do so. If the market goes down, you're going to be buying more. Fantastic. But I think where you could need the advice is like, where do you put it? How do you put it away?
No. That's the financial planning side. Yeah, absolutely.
Yeah. What options are you using? And even with the funds, I think that we need to be cautious with that. And, I talk to people who are younger as well, and they're like, hey, if I'm just going to put it into this. Well, great. Well, they may put everything into international. International could be, in the dumps or going into the dumps. They may say, hey, that may not be the best place to be. Maybe we want to be over here. It doesn't mean we're not still invested. We may just be differently, investing differently. So, but I think the main thing with that is from a financial planning perspective, there's a lot of things that you need to do to make sure you're taking advantage of. I mean, I would encourage somebody young to say, hey, go find mentors and go find mentors in different age groups. Find somebody, if you're 20, find somebody in their 30s, 40s, 50s, 60s, because they're all going to give you a little bit different advice because of their, everybody's experiences are going to be a little bit different. Access to different types of products, markets are all different. But I think the older you get, the more people will tell you, I wish I would have done this when I was your age.
Exactly.
And so I think that is very, very helpful. An advisor can tell you the things that you need to be doing right now. Like, we talked about in that second segment. Hey, look at your health savings account. Max that out. Don't use it like this. Are you or do you have access to a Roth IRA or 401k, Are you using it? Here's why I would start thinking about putting some funds here. Maybe you don't put it all. Maybe you do put everything into it. When you're not making much money, which most people when they get out of school aren't, that's probably a great thing to do, right? Because you're not going to be taxed very much. That those funds you're putting in get to grow tax-free. So there's a lot of small things surrounding that. But I think the time is really crucial. And I see people make mistakes with time too, where maybe they didn't do all those things when they were younger and they're like, I'm going to retire in 3 years. I need to get super aggressive.
Yep.
And then we start talking about like, whoa, hang on. So we're making up for lost years that maybe you didn't contribute enough for, you didn't do the things that you thought you should have to get to where you want to be. But now you're expecting the market to make it up where, I may encourage you and say, hey, maybe most people don't like this. Maybe we need to pare back. Maybe you need to look at this differently. Maybe you need to fund a little bit more. And then look at all the avenues and what's feasible. What can you actually do versus just saying, hey, I'm going to go all in. And in certain environments, yeah, great. But what happens, my question then is, okay, let's say you make an extra 10%. Great. Is it life-changing? Probably not. Right. What if you lose 10? What if you lose 20? What if you lose 30? And now you're going into that retirement. Is that life-changing? Now you're taking distributions. Could be.
Yeah.
And so that's the tough part, I think, for many people to understand.
And that's what I'm saying. Time is so important. If you don't have a lot of time to retirement, you've got to be much more focused on risk management. And, I get these emails, like I said, I get these emails from young people, and they're like, what can I do to, I've got 20 grand to invest right now, and, what can I put it in to make the most money? It's like, that's not investing. That's just speculating and gambling. The first piece of advice is pay off your debt, and then never use debt again other than a mortgage. Then, start saving up an emergency fund. So you have 6 months worth of savings. Because once you do start investing, you don't want to have to be forced to tap into that, right? We talk about people tapping into 401k plans, et cetera, because they don't have any money saved up at home. So save up that emergency fund. Fully fund a 401k Roth account, like Danny said. So if you're young and you've got access to a 401k Roth, fully fund that every year. That's, if you can't fully fund your 401k every year, you need to work on your budget at home. You need to focus on getting to that point. You may not be able to do it right away, but you need to focus on your budget at home and get to fully funding that 401k. Make sure your wife is doing it if she has access to one. If she doesn't have one, she's not working, do a spousal Roth IRA. But the point is to start building these savings routines over time so that you're saving 30 to 40% of your income, living on the balance. There's a great rule to follow if you're young. It's the 50-20-30. Spend 50% on your utilities, essentials, mortgage, those type of things. 20% is basically your living, your entertainment, those type of things. 30% is savings. If you do that and save, and to like Danny's point, HSA, 401k Roth IRAs, those type of things, you'll be great, right? Because you're saving enough money. You can't help but be successful if you're consistently saving.
Yeah, and I think if you're doing things that aren't, so far outside the box, so many people look for the get-rich-quick schemes in there, and that's where many people get in trouble. Like, oh shoot, I lost all this, and so you got to be careful as far as how you do that as well. Where we're just being consistent with it. You're understanding the time. I see another problem, generally speaking, with what people do, is that we may get into a bear market or a recession, and a lot of people stop their contributions. It's like, no, this is what I want you to continue to contribute. Now, if you've accumulated wealth, let's talk about how do we protect that. But, with the remainder, we're putting funds in. I mean, there may be a time we go to cash for a bit, but we want to start buying along the way, buy a little bit as you go. And so I think that's a struggle for many people. And listen, I understand a lot of you out there and many people, you can't fully fund a 401k. But go back, look at where your expenses are, what you have going on, and then back into those numbers. Find a way for you to get there because you're going to be much better off further down the road.
Absolutely. All right, Danny, thanks so much. All right, wraps up the show for the day. Get by the website. Mike's latest article is out on the website, actually talking about employment today as well. So, again, that's on the website, realinvestmentadvice.com, where you're there. Send us your questions, comments, emails. If you need help, Danny will answer all of your financial planning questions. He's got tons of time. He really doesn't do much else around here. So send your financial planning questions to Danny. I will forward them all to him, and he'll answer those for you in detail, like very long, detailed explanations. He will help you. So, for free, even better. Realinvestmentadvice.com. Have a great day. See you back here tomorrow.